So what option strategies would I put down now? So right now, the best strategies that work, so that before strategy. So again, stock forecast toolbox, next 10 days, the model basically says all aboard, positive trend, bulls are in control. Doesn't matter what the news are, good news, bad news, fear of missing out, we're buying stocks because the future looks bright, right? So uptrend. 6 months, the vector got a lot more basically neutral. If it was negative 6–10% before, now it's basically neutral. Model basically says based on the current price action, it's a neutral strategy, right? Market model is neutral. If the model is neutral for the next few months, the best strategies that work are market neutral strategy, cover call, spreads, butterflies, iron condors. I mean, you're limiting your upside, but you're also limiting your downside. So in the lead circle, this is kind of a classical example. Iron condor, right? So my favorite strategy are spreads. Sometimes I do multiple. So I am buying TLT on pullbacks, right? TLT pullback, right? I think in both cases scenario, whether it's a soft landing or hard landing, interest rates are going down, just for different reasons, right? Soft landing, they're going down because inflation is contained and there's no reason for, employment is high. There's no reason for the Fed to continue, staying in these restrictive levels. So it'll just lower interest rates, futures data showing that as early as November. Hard landing basically says that Q1 or Q2, we will start to see earnings recession. And for that reason, Fed will start lowering interest rate. So in both scenarios, they basically think interest rates are going down. So I'm keep accumulating TLT. The risk, if inflation comes back higher, right? If you look at CPI historical data, and this becomes more and more persuasive. CPI historical chart. Where's the chart? Let's see it. Where's that consumer? Year by year. I don't see it. What am I looking for? Sorry, let me just CPI historical history by months. Okay, so this, right? So CPI, consumer price index for consumers, right? So there was a big rally, big pullback, right? Was it from 74 to drop to 76, right? And then from 76 to 79, 80, big jump, right? So Fed is pretty worried about a repeat of 70s and 80s, right? Where for a couple of years it drops, and then interest rates go down, the economy is expanding, and then inflation goes back up, right? Where the soft landing basically says, no, this is a transitory, is just a little bit longer transitory than everybody anticipated. So that more and more people concerned about this wave, right? Which would make, obviously market would drop a lot more if that is the case. So that would be the risk, right? That would be the risk of buying TLT, because if inflation does come back, right, like in Spain and Italy, inflation was higher than expected, right? If we have a couple more data points, or in the United States, we're going to have a print higher, then TLT will drop. I still think Fed is not going to make the same mistake. They're not going to pivot, right? They're going to stay on the course at least until the end of the year. So for that reason, I think this is my favorite trade, is keep buying TLT or other, bonds. Not high yield bonds, but corporate bonds, high grade corporate bonds, municipal bonds. So the strategy that does work in this environment for me, Apple, right? Apple announced earnings, right? As long as Apple is trading in the range, I was able to collect 65 cents on the call, 41 cents on the put, $1 on a stock that trades around 140. I closed the put, call, Apple is reversing, so there is a risk, right? There is a risk to the upside, right? But that's the strategy, is the iron condor, right? That the Apple will reach 160 level, right? And then I would have to, either hedge my position or close the position. Maybe I can just close it and not take more risk, which I'm gonna do. I mean, it's low probability it's gonna jump another 2%, but who knows? I mean, market is reversed. Now I'm just gonna close it. I don't want to take too much risk. Okay. So that's the strategy, right? It's the selling iron condors, right? I sold 139, 127 put. I sold 160, 180 call, collected $1, and my risk is $12, right, on the put spread. $12 on the put spread, on the calls actually a little bit wider, 20. So 1 out of 12, that's about 9% risk out of 25%, but you can get 5% return, 10% return on the risk you're taking. On the stock, on the value of the stock, about 75 basis points, 50 to 75 basis points. So the point is, if you can make 5, 10% return on your strategy, it accumulates, right? So it's all about compounding investing. You can do the same strategy. The reason I'm doing Apple is because one of the, again, their argument that VIX is very low, right? VIX is, reach 17 level. With all the uncertainty we have in the market, VIX at 17 doesn't seem like a reasonable number. But the consequence of that there is less premium in the options. So earnings obviously give you a boost into the VIX, into the premium of the options. But you can do the same strategy with ETFs, spiders, QQQs, or stocks that you're trading. Let's say you do want Tesla, right? Everybody's asking me, should we buy Tesla? I think as long as you're a short-term trader and your time horizon is May, I think it's a higher highs, higher lows, right? Buy and pullbacks. The strategy going into April, May, buy and pullbacks. Market pulls back, you buy Tesla, because Tesla is going to lead the market, right? If you don't have an exit strategy and you're going to hold it for the next year or two, you can buy a small amount, but I still think we will revisit this level and probably break this level to the downside at some point. It might not happen H1, but more likely it will happen in H2.